Have you ever wondered where money actually comes from? Most people believe the government prints it, and banks just hand it out. But the truth is far stranger and way more powerful. When you take out a loan from a bank, you're not borrowing someone else's savings. You're helping to create new money. In this video, I'll show you how modern banks create money out of thin air, and how this affects your wallet, the economy, and the entire financial system. Let's break it down. Part 1. The common misconception. Ask the average person how banks work, and they'll probably say this. Banks take money from depositors and lend it to borrowers. Seems logical, right? But that's not how it really works, at least not in modern banking. Today, most money is not created by printing bills or minting coins. It's created digitally by commercial banks when they issue loans. Part 2. How money is really created. Here's what actually happens when you take out a loan. Let's say you apply for a $100,000 mortgage. The bank approves you and you sign the paperwork. Now here's the twist. The bank doesn't take $100,000 from someone else's account. Instead, it creates a brand new deposit in your name, out of nowhere, digitally. Your account balance increases, not because someone lost $100,000, but because the bank added it into existence as a loan. That loan is now both an asset for the bank and a liability for you. But the money? It's real. You can use it to buy a house, transfer it, spend it, just like any other money. This process is known as credit creation, and it means most of the money in the world was created by debt. Part 3. What is fractional reserve banking? You might be wondering, how can banks just create money? Isn't that risky? Here's where fractional reserve banking comes in. Banks are only required to keep a fraction of customer deposits in reserve, say 10%. The rest? They're allowed to lend it out. But when they lend it, they're not physically moving cash. They're creating new deposits, which expands the total money supply. And it doesn't stop there. Let's say Bank A lends $10,000 to a business. The business deposits it into Bank B. Bank B now keeps 10% and lends the rest. This cycle continues, multiplying money throughout the economy. This is known as the money multiplier effect. Part 4. Debt equals money. Here's the big idea. Every time a loan is made, new money is created. And every time that loan is paid off, money is destroyed. That's why debt and money are two sides of the same coin in today's system. It's also why modern economies rely on borrowing to grow. No new debt and no new money. And when credit tightens, the money supply shrinks, often leading to recessions. Part 5. Why this matters to you. Understanding how money is created gives you an edge. It explains why governments care so much about interest rates, inflation, and lending activity. It shows how central banks indirectly influence the economy through policies that encourage or discourage borrowing. And it highlights a deeper truth. Money isn't just printed, it's designed by a system that depends on credit, confidence, and continuous growth. Let's do a little recap. So the next time you hear someone say, banks just lend out savings, you'll know the truth. They don't lend old money. They create new money and reshape the economy in the process. If this blew your mind even a little, hit that like button and subscribe for more simple explanations of how money really works. And if you still have questions, drop them in the comments. We've got more deep dives coming soon.